Hey guys, welcome back to another week of Mortgage Matters in Minutes. We appreciate you checking in these last few weeks and following along with us to become better educated in the world of real estate finance, obviously, especially mortgages. So, this week we're going to talk about long term locks, and that's been a huge question these last few weeks as interest rates have been slowly creeping up, and they've been going up due to obviously inflation and the Fed speaking about increasing the overnight federal funds rate, which a little bit of education on that doesn't directly impact mortgage rates, but it can indirectly. We've talked about that and put lots of videos out about how that exists. But specifically, people are calling, or clients are calling after they've written an offer, got it accepted with a new builder in building a home, but the house won't be done for 6 months, 9 months, 12 months. And a lot of clients are getting nervous because as rates go up, obviously that's affecting your payment. And with a higher interest rate comes a higher payment. So borrowers and our clients are asking about what is a long term lock and what does that mean for me? So let's talk a little bit about long-term locks. Really what long-term locks mean is that we can lock in the interest rate for a longer time frame. A normal locked-in interest rate is anywhere from 30, 45, or 60 days. So if you lock in your interest rate, you're guaranteed that interest rate for the time frame that we lock it in, 30, 45, or 60. If for whatever reason the loan does not get done in that time frame, that lock does go away. So we really need to be concerned about the time frame that we need to close. And that's why when individuals get under contract, we want to find out when the closing date is so that we're able to give them the accurate information or accurate rate lock through their closing date. So where does a long-term lock come into play? A long-term lock comes into play again when someone's building a new house and the house isn't done for 6, 8, 9, 12 months, but they want the interest rate today. And what I can share with you in summary is that if you want a long-term lock, the interest rate is not going to be the same as it is today. Because of that risk moving forward, they're going to hike up, increase the interest rate to give themselves some insurance risk because rates generally should, in theory, always go up more than go down. So because of that risk that's involved, the mortgage lenders are going to give you a higher interest rate. And there's a lot of different options for long-term locks. It gets a little confusing between lender and lender. While us being a mortgage broker, we have multiple options to go through for you to see which particular lender has the cheapest cost for long-term locks and the cheapest interest rates. So let's talk through kind of a quick example of a long-term lock. And let's kind of use a 6-month, so 180-day rate lock is kind of an example. So if today's going interest rate is 3.75, they're going to add 0.375 to that interest rate. So if you wanted to lock the rate for 6 months or 180 days, and today's rate is 3.75, you would be able to lock in at 4.125. What lenders do know is they've seen people lock and jump around from lender to lender. So what lenders are going to do if you want to take advantage of that long-term lock, they're also going to charge you an upfront fee, and that upfront fee usually is about 0.5% of your loan amount. So if we're building a $400,000 house, 0.5% of $400,000 is $2,000. So they would charge you, and you would write a check right away today to lock in that rate for $2,000, and you would get an interest rate of 4.125. Now again, you would have to close that transaction or that new build within that time frame. And the risk that's occurring right now is because of the shortage of inventory, because of the shortage of supplies, because of the shortage of the workforce, we and the builder can't control when that house is necessarily going to get finished and going to get done. So even though we do lock in 180 days, that house does need to be complete. So that's a good example of 180 days. If you lock longer, like a 9-month or a 12-month, obviously the interest rate is going to be higher. So they're going to mark up that rate not 0.3%, they're going to mark it up maybe 0.5% to 0.75% higher, and still also charge that upfront money. So a lot of clients will contact us and ask, what should we do? Should we lock in that interest rate or should we wait it out? Up until these days, we've basically stated for clients to wait it out, and that always has worked in the last 20 to 25 years because rates have come down. Here at some point in time, we're going to have some serious discussions on when is the best gamble, because that's honestly what you're doing by locking this in, is gambling to see when that time frame is. We also work with a lot of economists that predict and follow the interest rates of what the trading of mortgage-backed securities does, and we've keep clients posted and have for years about what the interest rate is going to do. So we can give you the best advice, but a lot of times it's still your personal decision on what to do and when to lock, because none of us can completely predict the future. So at some point in time, even after you have the information, it's going to be your decision to figure out what is the best for you and your family. So again, long-term locks make sense. The last bit about long-term locks that you can also do is add on a float down option. And generally what that means is that if interest rates do lower by a certain percent, you're able to take your interest rate down a little bit. Usually the formula is if your interest rate drops by about 0.5% or more, then you're able to lower by about 0.25%. They're not going to always give you interest rate for interest rate or dollar for dollar, but they're still going to give you a benefit if interest rates do drop. You have to actually pay a little extra for that float down, but many times in these really volatile markets, it's also a good add-on to pay if you're also looking at long-term locks. So hopefully today you've received a little bit more education about what it takes, or what a long-term lock means, how much it costs in additional fees up front as closing costs, and also higher interest rates. Also, the third piece is being able to use that float down option. That's also very advantageous if interest rates should start going the opposite way, going up and then coming back down. So you can cover both bases there. Thank you guys for all tuning in here today with another week of Mortgage Matters in Minutes. We're going to be talking next week about interest rates and how they're going to be impacted over the next 3 to 12 months, and give you our prediction here, what Mortgage Specialist is planning on seeing moving forward. So you want to make sure and tune in there. And we'll see you guys all next week, next Tuesday at 3 p.m. for another week of Mortgage Matters in Minutes. In the meantime, if you have any questions, feel free to call us at 402-991-5153, or you can jump on our website at mtg-specialists.com. Thanks for all checking in. We'll see you all next week. Mortgage Specialists. Driven, trusted, reliable.